In a market where interest rates have soared to levels not witnessed in over 15 years, many individuals are wisely redirecting their funds towards bonds and high-yield savings accounts. The allure lies in securing attractive interest rates amidst this new financial landscape. However, history has shown that stocks outperform bonds and cash by a substantial margin when it comes to capital growth over time. Enter dividend stocks, the perfect blend of benefits. They offer a steady income stream in the present while simultaneously possessing the potential for significant long-term growth, surpassing most alternative investment options. Nevertheless, given the current economic uncertainty and the looming possibility of a recession, investors must exercise prudence and caution in their selection of dividend stocks. Hi, and welcome back to our channel. Today, we'll be looking at top 10 dividend stocks. Number 10. Amgen Inc. Amgen, one of the largest biotech companies in the United States, has garnered significant success by developing and providing a wide range of FDA-approved drugs for various medical conditions, including cancer, inflammation, and renal illness, among others. As some of its medications near the end of patent protection, Amgen is proactively bolstering its portfolio through the introduction of new drugs, both through its research pipeline and strategic acquisitions, like the purchase of Onyx Pharmaceuticals. This strategy not only compensates for the upcoming patent expirations, but also reinforces Amgen's position in the field of cancer treatment. However, regulatory scrutiny surrounding Amgen's proposed acquisition of Horizon Therapeutics plc and the broader sell-off in the healthcare and biotech sectors have led to a decline in Amgen's stock price, nearing its 52-week lows. Consequently, the shares now trade at an appealing valuation of approximately 13 times forward earnings, with a dividend yield of around 4%. Number 9. Kimberly-Clark Corporation. Kimberly-Clark, a consumer goods manufacturer, has faced a turbulent period marked by various challenges. Initially, during the early stages of the pandemic, the company experienced a temporary boost in revenue as individuals stocked up on toiletries and cleaning products. However, the sustained usage rates of these products did not witness significant improvement, leading to a subsequent decline in earnings. Kimberly-Clark's record earnings were further impacted by a significant wave of inflation and disruptions in the supply chain. Nevertheless, the company has made a recovery and is now on the right path. Price drops in essential raw materials like wood pulp have contributed to improved corporate margins. With the potential decline of inflation and the return of the economy to normalcy, Kimberly-Clark is positioned to increase its profits. Despite significant expansion since 2016, the company's shares have only seen marginal growth. This suggests that once earnings improve and market sentiment strengthens, the stock may present substantial upside potential. Number 8. OneMain Holdings Incorporated. OneMain Financial is a significant player in the specialized lending industry, offering consumer credit loans specifically tailored for individuals with comparatively poor credit. With a robust internet lending channel and a widespread presence of over 1,400 branches across 44 states, OneMain has established a strong foothold in the market. The company's loan portfolio currently exceeds $20 billion. While investors express concerns about the resilience of credit quality during economic turndowns, it is worth noting that OneMain has a long-standing presence, having previously operated as a subsidiary of Citigroup Incorporated. Furthermore, its experience in navigating through the financial crisis of 2001 and 2008 has provided the company with invaluable data and operational expertise. Despite recent market turbulence, OneMain's stock is currently trading at a modest valuation of 6 times projected earnings and offers an impressive dividend yield of over 10%, making it an enticing investment opportunity. Number 7. Washington Trust Bancorp Incorporated. Washington Trust Bancorp, the largest bank based in Rhode Island and one of the oldest community banks in the United States, has a long-standing reputation for prudence and a remarkable track record of paying dividends for over a century. However, despite its strong foundation, the stock of Washington Trust has experienced a significant decline of nearly 50% in 2023 due to a broader sell-off in the banking sector. This drastic decrease in stock price seems to be an overreaction, considering that Washington Trust has avoided exposure to riskier areas such as startup capital and cryptocurrencies that have affected other regional banks. Furthermore, the bank has demonstrated stability in its deposit balances, with no issues reported as deposits remained consistent during its first quarter. Number 6. Canadian Natural Resources Limited. Canadian Natural Resources holds a significant position as one of Canada's largest businesses and plays a crucial role in the country's energy sector. The company's foundation lies in the Alberta oil sands, an abundant resource that has historically faced investor hesitation due to high development costs and the limited infrastructure in northern Canada. However, the dynamics have shifted in recent times, with increasing challenges from politicians and environmentalists in establishing new oil extraction facilities in developed nations. Existing operations in the oil sands have gained strategic importance. The oil sands distinguish themselves by offering extended lifespans with low rates of deterioration, in contrast to fracking, which experiences rapid declines in oil production output. This favorable characteristic makes Canadian Natural Resources a compelling choice for investors seeking long-term stability in the energy industry. Number 5. Eastman Chemical Company. Eastman Kodak, once a dominant force in the photographic industry and a prominent blue-chip corporation, struggled to adapt to the digital photography revolution and fell behind its competitors. However, in 1993, it made a strategic move by spinning off its specialty chemical division, which became Eastman Chemical. Since then, shares of Eastman Chemical have experienced remarkable growth, generating a cumulative return of over 800%. Eastman has leveraged its expertise to develop exclusive compounds for cutting-edge applications such as solar panel composites, virtual reality displays, and car tinting technologies. These specialized chemical uses offer higher profit margins and greater stability compared to commodity chemicals. While the chemical industry is often considered cyclical and attracts caution from some investors, Eastman Chemical has demonstrated a superior business strategy. Its shares trade at a reasonable valuation of 10.5 times projected profits, provide a dividend yield of 3.8%, and the company has implemented a substantial share repurchase program. Number 4. Grupo Aeroportuario del Pacifico S.A.B. de C.V. The Pacific Airport Group, responsible for managing airports in Mexico and Jamaica, operates under the name Pacifico. It oversees 12 airports in Mexico, including major cities like Guadalajara and Tijuana, as well as popular tourist destinations such as Puerto Vallarta and Los Cabos. The airport concessions in Mexico are valid until 2048 and can be extended until 2098, providing long-term stability for the company. Despite the challenges posed by the COVID-19 pandemic, Pacifico experienced a swift recovery in airport traffic due to the relatively relaxed restrictions in Mexico, which supported the travel and tourism industry. In 2022, Pacifico witnessed a remarkable 16% increase in traffic compared to 2019, surpassing pre-pandemic levels. Moreover, the year-to-date traffic in 2023 has seen a 19% rise compared to 2022. The company is capitalizing on the unprecedented investment boom in Mexico, fueled by reshoring and manufacturing opportunities in North America, leading to rapid expansion. Pacifico follows a variable dividend policy, distributing a significant portion of its annual free cash flow to shareholders. Number 3. International Business Machines Corp. IBM has long been overlooked by investors, mainly due to concerns that the company would struggle to keep up with the rise of cloud computing. As it transitioned away from its traditional hardware business, IBM faced challenges in positioning itself for the evolving tech landscape. However, significant changes have been set in motion, such as the recent separation of Kyndryl Holdings Incorporated, which eliminated the least dynamic aspect of the business. Moreover, IBM has made strategic moves in emerging technologies, notably its acquisition of Red Hat, positioning itself as a key player in the hybrid cloud market. The company's investments in Watson, its artificial intelligence division, also hold promise, especially with the growing interest in AI. IBM's generative AI strategy, combining Watson's capabilities with deep learning, was unveiled at the IBM Think 2023 event. With shares currently trading at a valuation below 14 times projected earnings and a dividend yield exceeding 5%, IBM presents an opportunity for investors to potentially capitalize on its transformation and future prospects. Number 2. Verizon Communications Incorporated. Verizon, one of the leading wireless carriers in the United States, stands among the top 3 companies in the industry. Renowned for their stability and consistent income generation, blue-chip companies like Verizon have always been attractive to investors. However, Verizon experienced undeserved repercussions from investors following its rival AT&T's dividend reduction, triggered by the failed attempt to acquire Time Warner. Although the telecom sector faces increasing competition and concerns about potential market entry by Amazon.com Incorporated, the subsequent stock sell-off in 2023 has created an opportunity. With a dividend yield of over 7% and trading at approximately 8 times projected profits, Verizon's undervalued position presents an enticing prospect for investors looking for solid returns. Number 1. Realty Income Corporation. Dividend hunters often turn their attention to real estate investment trusts. Although they have had a challenging year due to rising interest rates and declining real estate values. However, it is now more important than ever to carefully select high-quality REITs, and one such option is Realty Income. This American corporation stands out for its long-standing track record of paying monthly dividends. As a triple-net REIT, Realty Income enjoys consistent performance by having tenants bear essential costs, such as utilities and maintenance, rather than the landlord. This triple-net structure shields landlords from rising costs that have impacted other sectors of the REIT market due to inflation. Despite a notable drop in performance year-to-date, Shares of Realty Income are currently trading at a reasonable valuation of just 14 times funds from operations and offer a dividend yield of over 5%. What do you think of our video? Let us know in the comments below, and don't forget to like, share, and subscribe to our channel for more videos.